Hello and welcome to my morning note. Let's go for a world tour today. At the moment, stock markets in the US and some other parts of the world are at all-time highs. Similarly, bond markets and debt markets are also at all-time high valuations. And yet, the economy around the world is looking distinctly sluggish and unappetizing. It doesn't really look on the face of it as though there's anything anybody would particularly want to buy. But investors have to buy something. How do you go about dealing with that dilemma? With me today to discuss how he is trying to reconcile all of these problems is the Chief Investment Officer of ING Investment Management, Hans Stoter. Hans, let's start by taking a look at supply managers, purchasing managers surveys, all of which are handily fixed at 50 being the dividing line between contraction and expansion. This looks like a fairly gloomy picture around the world. How do you see growth being dispersed around the world at the moment?
Yeah, we see growth to be low for a relatively long period of time,
right,
but with regional differences. And I think this is shown quite well on this chart. We believe that Europe will continue to underperform in terms of delivering growth,
right.
But also the same applies to, for example, China, where we expect growth to disappoint. It still be relatively high compared to other parts of the world, but to disappoint, which also has its impact on markets.
Okay, but in terms of winning within the markets, where do you think the strongest chances of an upside surprise then compared to current expectations?
We see that still in the US and of course in Japan, where the BOJ new policy actually have led to a significant positive momentum for that market.
Now that's been a very strong trade so far this year, which it sounds like you've been in. Are you comfortable that it's going to continue?
It's a momentum market. So basically the market in general continues to buy what has done well. We believe that the chance of a positive growth surprise in both Japan and the US continue to be higher than that chance of a positive surprise in Europe and in Asia. And in investing, you don't have to take a position in everything. The only thing what you need to do is to take your positions in where you have the highest conviction.
Okay, so let's just quickly illustrate that with this next chart, which shows, according to MSCI, how the US has done relative to the rest of the world. Which basically means since the crisis, the thing to do was to hold on to the US. Your prediction would be that that line is going to continue moving steadily upwards and to the right, then that the US outperformance can continue.
Yes, that is our prediction for both the US and for Japan.
Okay, now let's take a look at the other great dilemma, which is the choice between bonds and stocks. And basically, since the crisis, as this chart shows, treasuries have very handily outperformed stocks. How do you go about making, a lot of your clients presumably are under pressure from their regulators to buy bonds. How do you go about dealing with this dilemma?
Yeah, it is clear that a situation like this, what you see on the chart with bonds outperforming stocks, cannot endure.
Right.
The 30-year bull market in government bonds is over. And with rates at the current level, there is very limited potential for attractive returns in bonds.
Okay, but does that mean we're going to get a great rotation that a lot of people were talking about from bonds into stocks?
Yeah, we believe that for a great rotation to happen, you need to have both a combination of negative nominal returns in bonds, which we haven't really seen yet.
Right.
We need to have sustainable global growth, where it's actually also shown on the previous charts, it's becoming more clouded actually. And we need to have a reduction of the tail risks in specifically government debt Europe. That box we can tick. That is working.
But Spanish and Italian yields have come down nicely.
The other two we really can't tick those boxes yet. So the great rotation out of bonds into equities, we haven't seen it yet. For retail investors out of cash into equities, we have seen, but not institutional investors out of bonds.
So basically, the trends that we've seen for the last year or two look as though they're going to carry on for a while longer, despite the disquiet. That's the way it's going to be.
Yeah, so movement has particularly been within bonds, from government bonds into credit asset classes or emerging market debt. We expect that to continue, and we see that basically every day in the flows in our funds. But an active move out of bonds into equities, many investors don't want to go there given their experience of 2008 or 2009, or are prohibited by their regulator to go there simply because the regulator doesn't allow them to take additional risk, even if they might want to.
Okay, Hans, thank you very much indeed. I think that was a fascinating tour of the world, and the ultimate conclusion is that a lot of those trends that have been in place for a year or two, self-contradictory though they may appear, are likely to continue. yield will continue to be king for a long time yet.